So again, this is the question that we did in class. What I'm going to do, I'm going to copy this question and I'm going to open Excel spreadsheet and I'm going to show you how you can solve this problem with Excel spreadsheet only. I'm going to stop sharing this. I'm going to turn on my Excel spreadsheet when the Excel spreadsheet is ready. Here you go. It's ready now. I'm going to share my Excel screen now. There you go. You should be able to see my Excel spreadsheet. I'm going to make it a little bit bigger. Like this. Okay, let's try again with the sharing. I lost the Excel spreadsheet somewhere. Let's try again and let's see what's gonna happen. Here it is. So let's share this Excel spreadsheet. Let's make it again bigger. So I can see it like this. And let's post the question here. There you go, that's our question. Now, can we solve this question with Excel spreadsheet? Yes, we can. The first thing I have to do is to extract the information. So what we said, we looking for what we have here. We have a new machine which has a cost of $100,000. I have to be careful here with formatting the cells because they're not going to have the same format. Actually, I can give that one. I have cost. I have useful life of 6 years. What else I have? Small, those one are even bigger, like 18. What else we have? We have
discount rate 5%.
discount rate, but before that we have this $8,000, which is the salvage value of $8,000. Then we have generate the cash inflow, net cash inflow of 21,500. That's annual cash flow, $21,000. And the last one was discount rate of 5% in this case. 0.5, let's make it percent. 5%. That's what we have. So now, how are we gonna use this information? How are we gonna label this information in order to use it for the present value calculation purposes? I'm gonna show you in a second. Let's move this one up a little bit. So, cost will be the one that we have to use for our calculation to calculate. We need to get the net present value. That's our calculation. In order to get the net present value, I need the present value and I need the original cost or cost that we have, the current cost that I have to pay. Current cost, I already have it, that's $100,000. And the net present value will be the present value minus the original cost or the outflow that I have to pay right now. If this number is positive, that means the project is going to generate a return. If it's negative, it's not going to generate a return, which we're using for the discount rate. So the question is, what's the net present value? Before we get the net present value, we have to label this information somehow. Since this is the net cash flow that we're going to get every year over the 6 years, that will be our PMT. Now the PMT will be equal to 21,500. Next thing that we have to do is to figure out, is there any future value? Is there any money that we're going to get at the end of the year 6? Since there's a salvage value, that will be our future value. Then we have to see how many periods we're going to get this 21,500. 6 years, that means 6 periods. So that our N is going to be 6. And the last thing that we need is our discount rate. What will be the discount rate that we're going to discount all these numbers? Our calculation in order to get the net present value. Our I/Y will be equal to 5%. So at this point, I have all the necessary information to calculate my present value. So how can I do that using Excel? Very simple. Excel has a formulas. Watch carefully now. Click on the formulas, then going and look of the financial functions. Once you click on the financial functions, you have so many financial functions. So basically, once you stay on the function, it's going to tell you what you can calculate. In this case, we don't need to calculate the net present value. We need to calculate the present value, which is PV. And once you click on the present value, it's going to give you this table here. So there's some functions arguments that you have to enter for the present value. There's some explanation here. Returns the present value of the investments. Total amount that is a series of future payments, which how much is worth now. The series of payment, we're going to see it as annual payment every year over the 6 years and one lump sum at the end of the 6th year. And we're going to start entering the information. First, we're going to ask you for rate. Rate is your interest or discount rate, which is 5%. So rate is 5. N is the period. So if you stay on the rate, it's going to say here rate. This is the interest rate per period. For example, use 6% divided by 4 for the quarterly payments at 6% annual PR. I think it's some return, but I cannot say exactly what the P for stands for. But A is for annual payment return, annual payment return, something like that, or payment rate. Then when you click on N, it's going to say N is the total number of payments period in the in an investment. So how many total periods we have? 6 years, or 6 is our N. Payment, PMT. PMT is the payment made each period and cannot change over the life of the investment. So we getting exactly the same amount every single year, 21,500. That will be our PMT. Then we're going to the future value. Future value is the future value or cash balance you want to attain after the last payment is made. So basically, that will be the money that we're going to get at the end of the 6 years. That will be future value. $8,000 is our future value. The question is, how much cost us if we get those payments cash in? How much we have to pay today? So the last thing that left is type. This is a logical value. Now what we have to consider is when we make a payments. Are we making payments at the beginning of the period or at the end of the period? We already established in the classroom that it's way beneficial for you to make the payments or to pay the payments in the beginning of the period because you avoiding the interest over the year compared to the payment the interest at the end of the period. But for these questions, when we getting the money, we always getting the money at the end of the period. So for that reason, now the logical value payment is the beginning of the period, enter 1. Payment at the end of the period, enter 0 or forget about it. In those type of questions for the for calculation present value, we always getting, especially for the capital decision, we always assuming that we're getting cash at the end of the period. So we can forget about this line or enter 0. And click OK. And sorry, not here. That should be, let's move it here. That should be our present value here. And once we do that, we're gonna see that we have to pay today. In order to get $21,000 for 6 years at the end of the 6 years, every year, plus 8,000 at the end of the 6 years, once we get all those cash at 5% discount, today it's gonna cost us $1,150. So the present value here is, we can put it as negative, so convert this number to positive. It's gonna be present value at this cash that we're gonna get over 6 years, today worth 115,097.10. What's the present value, net present value? 15,097. Make sense? That was a very detailed explanation how to use the financial formula here in order to calculate the present value, apply to the formula here, get a net present value. And we're done. Now the good thing for you is I'm gonna post you this one available in Brightspace so you can use it later if you need it. So I'm gonna stop sharing this and gonna go back to the slides. This is how we're getting these answers, an answer of 15,097 using Excel spreadsheet now. So choosing a discount rate, obviously this discount rate, since the discount rate is the one that's going to change the formula. Let's see, let's go back to the discount rate and let's play a little bit with that Excel spreadsheet. Let's see what we can get from this Excel spreadsheet. Now, this is going to happen if this is the scenario. That's, let's say, question 1, this one. What's going to happen if we decide to change the discount rate? If our discount rate is not 5% anymore, let's say the discount rate is 7%, what's going to happen? Well, in this case, the present value goes down. The value of the money goes down. Higher discount percentage here, lower value of the money you're going to get. So the question here with this type of question is, what is, let's say, let's go back to the original calculation, 5%. If this is my calculation for this question. Now the question is, let's copy this. Let me flip it here. No, I can't. Move this one a little bit this way, and I'm gonna flip this one here. Now the question is, what will be the actual return on this investment? Means that where is the point that the net present value is 0? In order to calculate that and to see what's my actual return, I'm still going to use my cost, 100,000. I'm still going to be formula. Now I'm chasing here the net present value to become 0. How can I do that? Very simple. I already know my present value. So in this case, I'm going to modify the whole information here. I'm going to delete this, I'm going to delete this, I'm going to delete this. That will be my present value, and then I'm going to chase to how much is my interest rate. My calculation now will not going to be focused on the present value, it's going to be focused on the interest rate. How much is my interest rate? And that having in mind that I already know my present value. So how much is my present value? My present value is that much. And I'm going to enter it as a negative. The way you see it here, the number, exactly the same way, I'm going to enter that number. This is my present value. My payment is still 21,500. My future value is still the salvage value, 8,000. My periods are still 6 periods. So the last thing that left is to calculate how much is interest rate. How can I calculate the interest rate? Same idea. Go to the formula. And now you have to be careful here, because you can see, you might not be able to see anything that looks like a IY. You may see internal rate of return, but that's not what we're chasing. We're chasing here in our present value formula, we try to find the rate. Make sense? So in order to find the rate, we have to see which is the formula that calculating the rate. And that's the formula that calculating the rate. Once you click on the rate, now you still have to enter the same information, but now you're chasing the return. Returns the interest rate per period on the loan on investment. For example, that's exactly the same thing that we saw in the previous calculation for the present value. And now I can start entering the information. N is still 6. And is you can just fix 6. Oops, sorry, I hit wrong button. Let's try again. Again, go to the financial, put the rate, that's what we're chasing, and 6, payment, 21,500, present value. Now the present value, the total amount of series of future payments which worth now. So since the way you have to calculate, receive or understand the present value is if you get those money in the future, how much you have to pay today. That's why we entering the present value with negative amount. That's our present value here, and the future value is positive $1,000. So now we have to see how much is the interest. In this case, we come up with the interest rate, which is 5%. So that's exactly the same interest rate that we get in here. Make sense? That interest rate here that we're using in this formula give us present value of negative 150.97. If I use exactly the same amount, my calculation naturally is going to come up here with 5%. But what we said, I want to see here, I want to see net present value 0. So which is the amount that I have to enter here as a present value? Is it $150,097 or something else? So again, if I want to see here 0 and I subtracting present value from the cost, my present value need to be 1,000, correct? So
Yes.
if I enter here negative 100,000, My interest rate, again, if my present value is 100,000 here, so that's 1 million, 100, 1, 2, 3, I'm going to get 0. So what's the actual interest rate, which is going to bring me to 0? And that will be, let's see how my exact is. This is the exact interest rate that makes this formula bring it to 0. So my actual return on this project is 9.39%. So the other way we can do this, if I flip this percentage here in that calculation, that should naturally bring the present value to 0. Let's see if that's going to happen. That's exactly what happened. So my actual return on this project or on this investment is the amount that you see as a percentage. If you get 10% return, now the net present, or if you discount it at 10%, now you start losing money. This project's not going to give you 10%. The actual return is, again, is 9.39. If you're waiting for 10%, you're not going to get it. But if you're chasing anything below 9%, you're getting. If you're chasing 8% return, yes, you're getting 8%. In fact, you're getting 9.39.63. So this is your break-even point as a return. That's where you are. Okay, that's with the present values. Let's go back to slides. Now slides are going to make more sense, especially with choosing the discount rate. Now usually the discount rate is the company cost of the capital. Now what's the company cost of the capital? Sorry, I have to go back to the Excel spreadsheet in order to explain cost of the capital. The question is, what is the capital of the company? In order to understand cost of the capital, the question is, what's the capital? Do you remember from the financial accounting, what is the capital? Sorry? Give me the basic accounting formula, please.
Asset equal to
Asset
liabilities
equal to liability
plus equity.
plus equity. Thank you, Irina. Okay, which one of those is your capital? Which one of those gonna generate a return in the company? Because you're chasing sales. And obviously you're gonna have expenses. And those two, one minus the other, is gonna give you income. Which one of those gonna give you that income? What do you think? You have asset, you have liability, you have equity. From where the income is gonna come?
From the asset.
Asset. So which is your capital? Assets. From where the capital comes, from the liability and equity. Either you have to borrow, either you have to invest. Make sense? Those are the two options that every owner, that's how you get the capital. This is your capital. Make sense? Assets your capital. Where the capital is going to come, either you're going to borrow it, and if you borrow, that will be your debt. If you investment, that's your investment. There's no other things. Investment. Now the question is, how much is the cost of the capital? Well, it depends on the cost of the debt and the cost of the investment. Because that one here is going to be equal to your cost. Depends how much you pay for your debt and how much you pay for your investment. Now, what we have to find out, what's the debt to equity ratio in order to get how much is the cost. So let's say you borrow the money from the bank and you're paying the bank 6%, right? And let's say your debt in that case, your debt is 40%. If your debt is 40%, how much is your equity? How much will be your equity if your debt is 40%? And you know the capital is 100%. You know that for sure. So how was
60.
60%?
60.
Obviously. There's no other magic here. There's no magic here. It's 60%. The question is, how much cost you that debt? You can easily say that will be equal to 40% times 6%. That's my cost of the debt. As a part of the cost of the capital. Now the question is, in this case, the question is, what is the cost of the investment or the equity? That's the biggest question that every company try to figure out. What is the cost of the equity? Because that's the number that on the debt you can easily see it. Check the contract, and you're gonna see how much you're paying to the bank, to on the bonds if you if you issue bonds, on everything. So you can easily get the cost of the debt. The question is, how can you get the cost of the investment? So simple question for you. If you have $100,000, watch this. If you have $100,000 and you open your own company, okay, you open your own company, you start your business. You wake up every morning at 6 o'clock. You're going to the office first at 7:30. You open the door. You're greeting your employees. You're smiling all day. You're dealing with the vendors. You're dealing with the customers, angry vendors, angry customers. You're dealing with the Canada Revenue. You're dealing with everybody else. Plus, you start try to please your employees so they can be happy, so they can come tomorrow again. If you're lucky, you may leave office at the 6 o'clock. Once you leave office at 6 o'clock, you're still thinking about the business, what's going to happen tomorrow, what's going to happen this, am I going to lose the money, am I not going to lose the money? Still going with your business ideas. If you're lucky, you're going to go to bed by 11, 12, but that's not going to be a sleep because you're stressed out, because you don't know what's going to happen with the business. And that's going to repeat 365 days. 365 days, you have to go through this over and over and over every single day. At the end of the year, December 31st, on the New Year's Eve, right? Or the old year, you're celebrating the New Year's, you're coming the New Year's, you're checking your bank account and you're seeing in your bank account you have $110,000. What's the return that you're generating from your company? How much return your company generate for you?
$10,000.
$10,000. So you get extra $10,000. As a percentage, how much is that?
10%.
10%. This one divided by your initial investment. So you're generating 10% return for the entire year by doing all the things that I told you, 365 days. The only question is, when you're sitting on the new year, do you want to do this exercise one more year to get another 10%?
No, Professor.
No, professor. So, because if you do it, your cost of the investment is 10%. If you're willing to do this exercise one more year, the cost of your investment is 10%. But you said no, right? And every normal person is going to say no to those 10%. So the question is, how much do you want? Because if you tell me how much you want, I can tell you how much is the cost of your capital. Do you understand this? So how much do you want? What is the number here that's gonna make you work on when you're sitting on the New Year's Eve? It's gonna make you to do this exercise one more year. What's the number that you want to see here?
30%, Professor.
How much?
30%.
30%.
30.
So if I see 30 here, watch this. If I see a here, now I'm getting here. Sorry, this will be 30% here. That percentage will be here, right? So the question is 30%. The question is, what's my cost of the investment? Since only I'm expecting from all the capital, only on the 60% of the capital, 30% I have to pay. It's going to cost me, that will be 30% times 60. That's going to be 80. So my cost of the capital is this number plus that number. This is how much costs me every dollar that I have in my company. So if I see project, if I see project that tells me if you invest 100 of your capital the way it is, and that project is going to give you 18% return, am I going to invest?
No,
Yes.
Yes or no?
no,
No. Why not?
No.
because it's less than the actual cost of the capital.
Make sense? Is this make sense to you?
Yes.
So
Yes,
what
Professor.
will be the project that's you gonna invest? Everything that gives you more than 20.4%. Otherwise, you cannot pay the cost of your capital. Do you understand this? Yes or no?
Yes,
Yes.
Professor.
Okay.
Yes, Professor.
So let's put this with numbers and to see if these numbers make sense. Okay? Let's put this with numbers and say work with the numbers. This is our structure, right? So let's say we have our capital is $100,000. How much should be my debt in that case? If my debt is 40/60, if my ratio on debt is 40 to 60, I'm still keeping the same capital structure. How much is my borrowing as a dollar amount? How much will be? 40,000, right?
40,000.
How much will be my equity in this case? 60,000, correct?
50,000.
Okay, so I have it. Now I'm in balance. If I invest 60,000, if I borrow 40,000, I'm gonna have $100,000. How much I have to pay on my investment, on the borrowing? 6%. So how much is gonna cost me for 1 year? 40,000 times 6%. $2,400. How much gonna cost me the investment when you want 30%? That's gonna cost me 60,000 times 30%. It's gonna cost me 18,000. So how much is my total financial cost in order to borrow $100,000? How much I have to pay back to my lenders and my investors? I have to pay them 2,400 to my lenders and 18,000 to
18.
my investors. I have to pay them $20,400. How much is that? That's exactly 20.4%, isn't it? And that will be divided, isn't it? Yeah. So if let's go here. Now let's go here. Sales minus expenses, net income. So if my sales from the period from the $100,000 that I'm generating or just manage to borrow and getting somebody to invest. Now this is my capital. The capital turned out give me $200,000 sales. My expenses are let's say $180,000. How much is my income?
20,000.
$20,000.
Now the question is, would you invest? Would you start this business?
Yes.
Yes or no?
No.
No.
No,
Why not?
we have
Cost
to
of
pay
capital
more.
is not covered.
Because I cannot cover my cost of the capital. Can you see it?
Yes, Professor.
So how much, now the question is, how much net income you want? Because of the operating, let's call it this operating income, or on after the operating income, you have to pay the cost of the capital, which you already know it. Your cost of the capital is
20,400.
20,000. So your actual net income in this case, it will be 20 minus this one,
Minus 400.
minus $400. So what you're not only not generating 100,000 return, you cannot pay the borrowing or you cannot pay the cost of 100,000 that you have, and on top of that, you have to go to your pocket and pay $400. Because if those people tells you, okay, you didn't pay me the cost, you didn't pay me my interest that I wanted, I want my money back. Do you have $100,000?
No, Professor.
No.
No,
How much you have? 999, 600,
600.
right? You're $400 short. So if these people tells you, I want my money back, you're in trouble. You don't have those money. So when you're gonna have those money, when you're generating income of how much will be that? 179, 600. If you generate operating income of 20,400, you're gonna have enough to pay for the cost of your capital And if these people say, I want my money back, you just pay them the money back and you're going clean. Is there anything for you? No,
0.
zero. So on which case you're gonna have something? When this number here, let's say 150,000, it's high enough, operating income high enough to cover your cost of the capital and something left for you. Make sense?
Yes.
All right. So now you understand what is the cost of the capital. Let's go back to slides. That's a very simple explanation of the cost of capital, but I hope it makes sense. So typically the discount rate is the firm cost of capital. So the interest that we're using to discount our project now, you can see, is the cost of the capital. The cost of the capital is the weighted average of the rate paid for the borrowing funds and the funds which are invested in the company. Now, this sentence makes sense, right? Because we get in here how we calculated in our Excel spreadsheet. How did we calculate the cost of the borrowing? Well, we're getting the weighted average, which is 40% of the cost, time the cost, we give you the weighted average of the cost of the borrowing. We already saw the weighted average cost of the borrowing is 2.4%. Why? Because I'm borrowing only 40% of my capital, and for those 40%, I'm paying 6% interest. What's the weighted average cost of my investment? Well, I'm investing only 60%, and then the investment I'm paying 30%. My cost of the investment is $18. So weighted average cost of my capital is 20.4%. I want to challenge you with one question here. Since I have this one, I'm gonna flip on the new screen. And let's call it this weighted average cost of capital. And now onto this one. So watch this. We know that capital is 100%, correct?
Yes.
I guess with me? Okay, where do I want to see this? Probably, yeah, we can build on this one. Let's go one step down. Gonna put this one here. And I'm gonna make it a little bit smaller so you can see the top and the bottom. That's the whole idea. Let's stay with this scenario now. So you can see here, if I borrow 40% of my capital and if I invest 60%, that will be my cost of the capital. Let's change this structure. Okay, let's change this structure. So let's put some formula so we can make it interactive. This one time this one is going to give you 40%. And in this case, this one time that one is going to make you 40%. And this one, this percentage here, Control C, that's 100% here. Put it in the middle. And this number here will be equal to 100% minus equity. So now we have some more interactive spreadsheets. So that means if I change some of the numbers, you can see the change. So imagine this. If your capital comes only and only from investment, how much will be your cost of capital?
$100,000.
100,000.
100%. So how much will be that? That will be equal to the cost of the equity or cost of the investment. Make sense?
Yes.
Do you understand this? It's very important for me you to understand and to understand this logic here, because it took me years to figure this one out. I want you to understand it now, so you don't have to spend the number of years that I spent to understand this. So watch this. If you don't have debt, my debt is zero. How much is my cost? Cost of the investment. But usually what we say, the cost of the investment is the highest cost, financial cost of the capital. So what's going to happen if at this point my cost of the capital is 30%? So you see the income that left for me is less. What's going to happen if I start borrowing money? This is the question here. And this is how the financial people figure this one out. Because this is pure finance here. What's going to happen if I borrow? What's going to happen with my cost of capital? It's going to go up or it's going to go down? What
Go
do you think?
down.
It's going to go down. Why is it going to go down? Give me logical choice. Why is it going to go down? Let's say now I'm not investing 100% anymore. I'm start borrowing from the bank, but I'm going to borrow only 10%. What's happened with my cost of capital?
Went down.
Went down. More money for me. So is it profitable for the company to be fully invested capital to come only and only from the investment?
No.
Not necessarily. Why? Because borrowing is always cheaper than investing. Do you understand this? Can you see it?
Yes, Professor.
Unless those people tell you, I want only 5%. If the investor tells you, I don't want 30%, I want only 5%, now only 5%, then it doesn't make sense you to borrow money, stay 100% on the investment. Because now if you borrow money, that's gonna drag up your cost of capital. But if the investors want, let's say, 50%, and you fully relying on the investment, your capital structure is fully rely on the investment, you have the highest possible cost of the capital. So in that case, you're getting zero income. But if you borrow only 10%, you're gonna add, but your cost of the capital, so in this case, actually, no, sorry, not that way. This way. If you borrow 10%, you see how much huge difference you have. From zero, now you're making $4,400. Why because you're borrowing 10% of your capital. And now you're reducing the cost of the capital. Does that make sense?
Yes, Professor.
I know this is not, it's kind of management thing. You have as a manager need to know it, but more like a financing thing. But since we're talking about the cost of capital, I want you to understand that in order we to continue with the slides. And now the slide's gonna make sense. So the cost of the capital is the weighted average rate of the paying the borrowing. And now if the project is believed to be the high risk, then the company discount rate should be increased. So if I increase the discount rate, that means makes the project riskier. So I expect one more return. More risk, more return. So then I have to adjust the discount rate. So the discount rate also is called hurdle rate, also is called required rate of return, also is called cutoff rate. Cutoff rate because if you don't meet that percentage, the project is going to cut off. Discount rate consideration. If the discount rate is increased, what's going to happen with net present value?
Decrease.
Decrease. If the discount rate decrease, what's going to happen with the net present value?
Increase.
Increase. We already saw that one. Now, discount rate can be increased if the perceived risk of the project increases. So, if you're sensing the risk in the project, increase the discount rate because you want more return. More risk, more return. Less risk, less return. Now, simplifying the assumption, if all cash comes at the end of the year, those are the ordinary annuities. All the cash received during the current projects are immediately reinvested into another project, which have the similar rates of return, and all cash flow can be predicted with certainty. Because if any of those is uncertain, we cannot make a calculation. Now, the also projected results are estimated that are based on the forecast belief about what most likely is going to happen. And one approach to deal with this is the uncertainty is to make that sensitivity analysis. So tell me if the discount rate increase, what's going to happen? Is it possible the net present value not to be affected?
No.
No. Is it possible the present value of the future cash flow to increase?
No.
No. Is it possible the internal rate requirement to increase?
No.
No. B is the answer.
So B is the answer. So that's another way to answer the multiple choice questions. Instead of looking for the right one, eliminate the wrong one and naturally come with the right one. Okay, so the capital budgeting challenges with when we have the intangible benefit, we always going to have those capital budget challenge intangible benefits. Now, to avoid rejecting project, there are two possible approaches. First, calculate the net present value by ignoring intangible assets. Intangible assets are anything qualitative. Then, if the net present value is negative, check the intangible asset benefits that you may have. Project rough conservative estimates of the value of the intangible benefits and incorporate those values in the net present calculation. That will be another way you to adjust the net present value. So the example will be company considering to purchase this soldering electrical components. Initial cost is $200,000. Net cash inflow are estimated 30,000 per year. Useful life 10 years. Discounted rate 12%. So what we're gonna do here? Let's see, based on our calculation on the Excel spreadsheets, what's gonna happen. I'm gonna grab the very first one. I'm gonna flip it right here. And that will be question 3. Eliminate this one and paste the new one. So what we have? We have cost, which is 200,000, correct? Cost is 200,000. How many years?
10 years.
10 years. Salvage value. Do we have salvage value? I don't see a salvage value. Do you?
No. No.
No. Let's change this one. Go to 10 years. What's the cash flow that we're gonna get every year?
30,000.
30,000. What's the discount rate that we want? What's the
12%.
12% return we want? Where we are? Are we getting it? Do we getting our initial cost? No,
No.
no. So in this case, we should not invest. Make sense? Because
Yes, Professor.
I'm not getting 12%. I'm getting way less than 12%. How much we're getting, we have to run the other calculation with the interest rate. That's all we have to do. What we have to do, we have to change my future present value to 200 and run the entire calculation again. So let's see the slides now. In this case, we're not accepting the project. Up to that, based on this information. So let's see what's here. If we're calculating, we're 13,493. However, there's some more information. They're expecting to improve the overall quality of their product. Because of the quality improvement, warranty costs are expected to noticeable decrease. So now we have a cost that decreasing. Sales are expecting to noticeably to increase. An intangible benefit in this case is the improved quality. Now the question is, how to incorporate this in our analysis? First thing, company has two options. Now we'll reduce the warranty costs, increase the sales, and improve the quality at least of 30,493. If they do that, project is acceptable. If they don't, project is not acceptable. Bear can make a conservative estimates for the annual cash, so they're assuming that the sales increase will be 10,000 per year, and warranty cost gonna decrease 5,000 per year. Make sense? We have increase of sales of 10,000 and warranty cost with 5,000. So the question is, where is that gonna hit us? So once we do the initial investment, we're gonna see the annual cash for reinvested 60,000, outflow 15,000. So the annual cash will be 45,000 that we're getting every year. So if we go to our calculation and increasing that amount from initial was 30,000, but now with the new changes, they're estimating that we're not going to get 30,000 anymore. In fact, we're going to get 40,000. Let's put it here. Now the new cash that we're getting is not 30,000, is now 40,000 per year. What's going to happen now? Are we accepting the project or rejecting it?
Accepting.
Accepting project. Why? Because now the net present value become positive. Means that we're gonna get the 12%. Definitely we're gonna get the 12% return. All right, let's share this slides again. So in this case, we generating present value. They come up. How they come up with the 45? Oh, the 45. I put 40, right? That's why the question. That's why I'm deviating. Let's adjust this one so we can have the right calculation here. Yes, I put 40. It's 45. That's even better, right? With 45. So you understand, increasing the net cash inflow affect the net present value. More cash inflow you're getting, let's say, if you get 50,000, the net present value even go higher. So in this case, they get 45,000. They get in 54,000 plus. So that means they're getting the 12%. What's going to happen if I increase here the discount rate? What's going to happen with net present value?
Decrease.
Let's see. If I put 15% here, you see the net present value go down. If I put 20% here, the net value become negative. So in this case, you can see what's the actual return that this project is going to give you. It's not 12%. Now we're going to 18%, 18 plus percent. So the actual return that you're going to get in this with project with the similar cash inflow over 10 years, that you're going to get return around 18 plus percent. When you discount it only at 12, it shows you that you're getting at 12%. Now this one, it doesn't mean, so how you can interpret these numbers? This 54,260, it doesn't mean that you're going to get that much cash. You shouldn't be interpreting this number, oh, I'm going to get the 12% return plus $54,260. No, 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 no. This is just a number, it doesn't mean anything. It just tells you, this number here tells you that this project with these parameters here definitely is going to cover 12%. And obviously you're going to get more. So in this case, we're going to accept the project. Let's see this question. What do you think about this question?
Salvage value.
Salvage value. Salvage value is tangible benefit, right? Everything else is intangible benefit. You make difference between tangible and intangible, right? Okay, so net present value firm are not able to accept all the projects with the positive net at the same time. So if you have two decisions, so one investing $500,000 and the other one investing $500,000, both give you positive present value. In that case, but you don't have $500,000. You have only one for $500,000 to invest in one project. The question is, on which project should I invest? Now, that makes the project more mutually exclusive. So now we have to choose the project with the highest net present value. That may not result the best decision. So choosing the one that has higher net present value, it might be not best decision. So how can we see it? Now we're going to the profitability index. The decision tree is, if the profitability index is more than 1, go for it. If the profitability index is below 1, don't. If the profitability index is equal to 1, now the project's break even, and the company would be indifferent which project to accept. So let's see the example here. How are we going to get that profitability index? Profitability index is calculated by dividing the present value of the future cash flow after the initial investment by the initial investment. So we're going to get the present value, PV, of the net cash flows divided by the initial investment. Here, the benefit is that the present value of all the cash flows, both positive and negative, does not include the initial investment. So let's see this. We have those two projects. Shall we do this together on the Excel spreadsheet?
Yes.
Okay, let's copy this and move to the Excel spreadsheet. I can run simultaneously this calculation here and flip this question. That will be question 3, question 4, and I don't need this thing. And paste the new one. Oops. Actually, that's bad thing. Let's paste it here. Let's see what's going on. Okay. I can paste it right here. Just a second. Let me do some formatting here and we can flip back to the original. Okay, so now we have the original information. What do I need? I don't need this one. I don't need this one. Now we have the two. In which your investment is, in the first case is 40,000. In the second case is 90,000, right?
Yes.
Net annual cash inflow, 10,000 here, and
19,000.
19,000 here. Salvage value, 5,000 here, and
10,000.
10,000.
10,000 here. Now, what else we need? We don't know the years, and we don't know the discount rate. Those things we don't know. So at this point, we cannot calculate anything. So let's see if on the slides there's any information about those ones. They actually doesn't give us that information, do they? I don't see anything as a present value here. Sorry, as a number of years. They give us this percentage here, which will be, I don't know from where they get those numbers. I know from where they get those numbers. They get those numbers from this table. So if you see table like this, that's on the equal, this is on the equal cash flows. And if you see table like this, and they're using here, what's the number that they're using for this calculation for the present value of the annuity, 565022. Do you see this number?
Yes.
So if we go to that table over here, when we're getting the equal cash flows, 565022, this is the number that we have. That number is equal if we getting 12% using 12% discount rate over 10 years. Make sense?
Yes.
So 10 years, 12%, that's the number. If you see this here, you're gonna have 10 periods. 12% is not here. This is lower than 12. So the 12% is here. So now we can plug those numbers in our calculation and see if we can get their numbers. In our calculations, what we need now, we have the missing information. Every project is 10 years. 10 years, and the discount rate is 12%. So both projects generate a positive net present value, correct?
Yes.
Yes, Professor.
But we said we're gonna ignore this. So now we have to decide on which project should we invest, because both projects give us that 12% is guarantee. So now which one has the highest profitability index? And the profitability index was present value, that will be a negative of this amount, divided by initial investment. So in this case, we're gonna get this number. And the second case, for the second project, we're gonna get that number. So in that case, on which project are you gonna invest? The one that have a higher PI. Make sense?
First one, yes.
Let's go back to slides. Now we know how to deal with this type of information. So which one is gonna be accepted? Definitely the first one is gonna be accepted, because the first one is gonna give you the highest profitability index. Uh, yeah, all the calculation is not available. Sorry, for some reason. Do you have it in your slides? But anyway, we have that calculation for our Excel spreadsheets, so I can easily copy this one and paste it right here, and you're gonna have it. So in this case, the project A exceeding the project B, which making project A more desirable. It's better for you to invest 40,000 and generate this present value, so that's going to give you higher return than if you go with the $90,000 investment. Profitability in the previous side, if the projects are not mutually exclusive and resources are not limited, then company should invest in both projects. So if the problem, the cost is not the investment, money is not our problem, both projects going to give us at least 12% return. So tell me which investment, which you're gonna accept, which one you're gonna which one you're gonna reject. We have initial investment, we have the present value of the cash flow, and present value of the outflow. Which one you're gonna reject? Which one you're gonna accept? What we chasing? Which the number that we chasing? What's the number that we chasing here? Do we care about present value of the cash inflows? Remember the formula for the present value. Present value of the net cash flows divided by the initial investment. What will be the present value of the net? We're chasing here the net inflows here. Make sense? So if we get this table, and if we flip it to the Excel spreadsheet, that should easily flip us Excel spreadsheet. Let's see if that's going to happen. Yes, that's easily flip us Excel spreadsheet. But I have to extend it a little bit, change the formatting, make it a little bit bigger for you to see it. and do the calculations. So what will be the net cash flow? What will be the net cash flow here?
Inflow minus outflow.
Obviously, that will be this one minus, actually plus this one, right? Since this is negative number, but it's not going to accept it because those are not numbers now. Those are like values. So I can have to change it to some numbers. And once I change it to numbers, it might, no, it's still not. Minus, sorry. Okay, now I have it. I don't need this. So now I have my net present, net cash flows. The last thing that I have to do is to get the
By
PI.
initial investment.
I have to get this number equal to this number divided by,
Initial investment.
which will be negative of that number. But now I have to change that number as well. That will be, actually, why do I need it? I can change those numbers a positive, right? Since I'm going to change the information, that will be 500 to 123. This one will be, and we can drag the formula and see what's going to happen. That will be 800, 123, 725, and 625. On which one you're going to invest?
B.
Definitely B, right? The second one will be D. If you have to invest in any of those will be the two that you're going to invest. So let's go to the slides and see how we're going to answer this question. Which of the two investments should be undertaken?
C is the answer.
B and D, right? Because those two have the greatest.
Yes.
And PI, yes, the C is the answer. So the risk analysis, now when we're doing the value, when we getting the value of the capital budgeting, those are estimated. That will be estimated result of the level of risk. One way to dealing with the uncertainty and risk is to perform sensitivity analysis. What will be the sensitivity analysis? Well, run the different calculation under different scenarios, and that will be your sensitivity analysis. Several outcome based on the variety of the potential return. Using the highest discount rate for the high risk project, using the high discount rate cash flow when it happens in the later year. What will be the post-audit investment? That will be thorough evaluation of how well the project achieved its target. So basically, if we accept the project based on the calculation and we make the investment, after that we have to see if what we did is the right thing or not. What we do by comparing the actual to projected results, that will be our check. That will provide to deciding whether the existing project should be continue or stopped. So how are we going to do this? Now we're going to use the same evaluation technique, which we used to originally calculate the decision. Either cashback method, either net present value. The difference is the actual numbers are used, but not the estimates anymore. So let's see this question. Using the several outcomes estimates to get the sense of the variability among potential return is what will be that? What kind of analysis will be that?
B.
Now again, the post-audit.
C.
So watch this. The post-audit analysis when we comparing actual with the estimated. Here we're chasing how sensitive our projection is.
C.
Is C sensitivity?
Yes. Let's go with this internal rate of return model. Now the internal rate of return method finds the interest yield on the investment. This is the interest rate that will result in net present value to be zero, or the way the net present value of the proposed capital expenditure equal to the net present value expected to the annual net cash flow, the one that I showed you earlier on the net present value calculation. So in the internal rate of return method is the internal rate of return is found by using the financial business calculator. We can using the calculator that I give you in class, or using the spreadsheet approach, which is Excel, which I show you today. And the other one is the trial and error approach. Try this and start flipping with the numbers and see which will be the number that's going to bring you to zero. By knowing that increasing the number, reducing the net present value, reducing the number, increasing the net present value, play with the numbers until you get it. If the cash flow from the project or investment are even through the life of the project, finding the internal rate of return is relatively straightforward. Now, if the cash flow are not even, then it's going to be a nightmare a little bit. Now, we consider purchase of a front-end loader with the initial investment cost of that much. Annual net cash inflow are estimated $100,000 over 3 years. What's the internal rate of return for this potential investment? And find the discount rate that yield is net present value is zero. So what I'm going to do, I'm going to get this information and we're going to use the Excel spreadsheet to calculate it. We don't need to use that trial error method once we have the Excel spreadsheet. That will be too much. So let's get this question one and build on question one. We don't need this information. That one is irrelevant anymore. This is what we need. So in this calculation, what we know, what we don't know. Now we have to change a little bit the information. Before we do that, our objective is to bring the net present value to zero, correct? That's our
Yes.
objective. We want to see net present value zero. When we're gonna see the net present value zero? When this number is equal to our cost. That's the only way the present value here is equal to the cost.
Yes.
So do I know the cost?
Yes.
Let's erase this information, so that's not gonna mess with us. I have the cost. Cost is 244,371. Do I know how many years?
2 years.
3 years. Do I know my salvage value?
No.
There's no salvage value, right? Do I know my net cash inflow?
100,000.
100,000 every year. So now I know my years, n is equal to 3. My future value is 0. Now, what I'm chasing this interest rate. I want to find what's the internal rate of return for this investment, or how much is this discount rate. So what I have to do, those two lines, I have to modify them. So here, I'm gonna looking for I/Y. How much is this one? But what do I know? Do I know my present value? What do you think? Do I know my present value?
No.
Yes, but what I know, I want my net present value to be zero.
Yes.
How my net present value will be zero?
Equal to cost.
If only and only with the present value is equal to the cost. So do I know my present value indirectly?
Yes.
Yes. And don't forget to enter the present value as a negative amount. That will be equal to negative cost. That's what I want. That's not percentage, that's gonna be a pure number. So now I can run the calculation. Financial, formulas, financial, go to rate, which is in the rate. N is 3. Payment, 100,000. Present value, I have it. Future value, 0. Type, I'm getting at the end of the period. So calculation, this. So let's go with, that's where it's gonna give you. Present value is this one. So if I want this present value to be 0, my interest rate, discount rate should be
11%.
11%. Let's see if this is true, because you may say, oh, that's too much. That might not be true. So what we have to do? We have to copy this calculation and run it again by plugging here as the discount rate 11%, right? Once we do that, we're gonna see if this actually works. So what is my cost? My cost is 244,371 over 3 years. Salvage value is 0. Annual cash flow 100,000. And we want 11%, right? So the only thing that I have to change here is the and useful life 3 years. Or this one, if it's equal to this number exactly, it's gonna give us exactly, because somewhere it's gonna have some numbers. Here we go. Right? It's not 11.000111 and then if we eliminate those one. So did I get net present value down to 0? Yes, I did. So what's the internal rate of return this project? 11%. So this is how they're doing it. We can avoid this one. Yes, internal rate is between 10 and 12%. So that means it's exactly 11%. Now the internal rate of the broke company example, that will be that how we're gonna, because of the annual net inflow are equal, internal rate can be found by two-step approach. First, we get the capital investment divided by the net annual cash flow, that's 2.4437. And not that we not use the total net cash inflow. So basically where we're going with this, we're getting the annuity. This is another way to get it. That's too complicated. The easiest way, as I show you, is go to the Excel spreadsheet. From the Excel spreadsheet, get it. So here they're getting with this number, and when they get this number, they're going for the table that I show you on the top, and they try to match which is this number over the 3 years, because we know that this is a 3 years period. 3 years, which is the number which is closer to that number. and we're getting 244,371. It's 11%. That's what they're doing here. If you're wondering how they come up with this 24437 and how they come up with 24371, one is the 11% return. Internal rate of return, decision criteria. Here's once the internal rate is determined, it's compared to the company required rate of return. If the internal rate is more than the company required rate of return, accept the project. If the internal rate of return is below the company required rate of return, reject it. Internal rate of return compared to the required rate of return. If it's greater, accept it. If it's below, reject it. What's the internal rate of return versus the net present value? Internal rate of return and the cashback method are widely used. Why? Because it's a little bit more easy to understand and easy to calculate. Where in the net present value you have more complex calculation. Let's see this question here. What do you think about this question? I'm trying to see the slides where this question was discussed. See if I can find it faster. But what do you think? Which one is the right one?
It's a D. Discount.
So watch this. Discount rate, often referred to as this one, or this one, or this one.
Hurdle rate.
So now that's why it's important you to know the terminology. How else we call this discount rate? We can call it hurdle rate, we can call it required rate of return rate, or we can call it cutoff rate. So let's go back to the question that asking this, which was right here. So in this case, minimum expected rate of return. Return on investment, is this a rate of return?
No.
No. Net present value, is this a rate of return?
D. No.
Cost of capital, is this a rate of return?
No.
No. So which one left? Hurdle rate. So let's do this one. This question, we can easily flip it in the Excel spreadsheet and do it there. Right? So we can use this question again. And that will be question 6. So now the industry consider purchasing, what they're purchasing of new equipment with the initial cost. This is our initial cost, 426,455, right? Which, if we're chasing the internal rate of return, we're chasing the net present value to be 0. So now its expected useful life is 5 years. The equipment is expected to generate annual cash inflow of 98,500 annual. Each of those years. And the minimum required rate of return for this company is 7%. What is the internal rate of this purchase? We already have it.
B.
Shall we accept it? What do you say? Shall I accept this project?
Yes.
So again, if the industry required rate of return is 7%, but this project give me 5%, should I accept it?
No.
No. Why would I? Make sense? I don't want to accept it. Because if I accept it, I'm gonna get only 5%. And everybody in the industry is gonna come and laugh at me and say, you see, we all accepting 7%, you accepting 5%.
5%.
Congratulations, you made a huge investment. In fact, you actually lost 2%. So in that case, 5% is the correct answer. Annual rate of return method. This is technique is based on the accounting data and indicates the profitability of the capital expenditure. The formula is expected annual income divided by the average investment. Average investment means that investment at the beginning, investment by the end, divided by 2. And that's going to give you annual rate of return. Also called simple rate of return or accounting rate of return or unadjusted rate of return or rate of return on assets. So you can see for this one how many different terms you have, which express exactly the same thing, nothing else. So how are we going to give it? The information is given the initial investment 130,000. Expected useful life is 5 years with no salvage value. Average investment will be 130 plus 0 since there's no salvage value divided by 2, 65,000. The accounting income generated from the investment will be, how are we going to calculate? Sales, now we're getting if we're getting this investment, that's what we're going to get. We're going to get sales, we're going to get cost, we're going to get the income before income taxes. We're going to have income taxes, net income is $13,000. So from this investment, when we run the entire year 365, at the end of the year, we're going to see 13,000 income. Well, now the expected rate of return is 13,000 income divided by 65 average, 20%. And then comparing with the required rate of return. If it's more than the required rate of return, accept it. If it's below, don't accept it. What's the pros for the annual rate of return? Relatively simple, and management is typically familiar with the accounting-based data. It doesn't consider time value of the money though. And this method relies on accounting numbers, which are very unreliable. So, what would be the answer here for this one? On what?
It's A, accounting data.
End of the accounting data. And that brings us to the end of today. So,